Hi, I'm Darren Mitchell. Welcome to Control and Compound. You don't want to miss this episode. We're gonna talk to the Findlay Mortgage Group, and we're gonna focus on real estate investors, how they get mortgages, how they get loans, what are the options out there, what should you be looking for. Let's jump right into it. Okay, so joining me today, we've got Josh Findlay and Ehren Laycock from the Findlay Mortgage Team. How you guys doing?
Good, Darren. How are you?
Fantastic. So you guys are Ontario based. Whereabouts are you in Ontario?
Yeah, we're located in Cambridge. Our head office is here, but we operate throughout the country.
Throughout the country. Great. So you can help someone with a mortgage in Halifax or Vancouver or GTA or anywhere in between.
Yes, sir, all across the country.
Yeah,
Uh,
we own a DLC franchise, so we do have some access. Like through our head office, they have their own like little lending desk that we can submit deals in through. So we have some other abilities in other provinces as well too.
cool. So I want to get into the exciting ride. I'm sure it's been on the mortgage front in the last 3 years. A lot of changes, a lot of ups and downs. But before we get into that, how did you guys get into the mortgage business? I assume at birth you decided you wanted to be a mortgage broker and have your own firm someday, and everything you did worked towards that. Was that the plan, or was it a little different?
Yeah, but we just snapped our fingers and it all happened pretty quick.
Yeah.
Yeah, it was the coffee addiction. It was basically which career path is going to consume the most amount of coffee, and let's just follow that one, and it ended up being mortgages.
Yeah,
So
sprinkling coffee, a little bit of stress, and we ended up here. No, so essentially, we went to university together. We're good buddies in university. We weren't in the financial field. I was in policing and criminal justice. Erin was in kinesiology. We were good buddies. We finished school, and like most people finish university, they don't just fall into their dream job, and that was our situation as well. So we found a job, and it was a pretty dead end job. We didn't really like it, and an opportunity came up to work with a mentor. My uncle, he's been doing this for a long time, and got into it. Realized it was decently lucrative, and realized there's some opportunity here. And Aaron and I decided to jump in with two whole feet, and a lot happened in between that. So we decided to open up our own brokerage right at the start of COVID when the world was ending. Um, you know, Rates went all the way to free money, went all the way back up to a ton of money, and the stars kind of aligned. So we essentially started creating some content, and the Findlay Mortgage Team is now what everybody sees. We have a team of people behind us, a lot of great agents, a lot of great support staff, phenomenal investors that we deal with across the country, and we are by far one of the best real estate investment mortgage brokerage firms in the country, and we pride ourselves in helping all of our investors scale their portfolios.
yeah, it's kind of like we were just talking right before we started recording this, but we were education first. Like when we were trying to learn, we just noticed a lot of stuff was American based. There wasn't a whole lot of social media content out there. So, we just decided that as, we were learning and growing, that we would just, expose all that and share with, the investors how we can help them. And, if they felt like we provided enough value, then they wanted to work with us. That was, a double win for us. And it's just, it's taken off ever since.
Very cool. Yeah, same as the control and compound model, right? We call ourselves financial educators. We educate people like crazy. If they want to do something with that information at the end, great. We're there to help them. If not, they receive the education. Okay, so as far as real estate investors go, and that's the focus of this episode, are you guys real estate investors yourselves?
Yes, sir. Yeah, do a little bit of private lending. I purchased multifamily real estate. Just finished an Aplex renovation and refinance, moving that into CMHC, and off looking for another building. So, always moving and shaking, trying to find new opportunities. As many people probably see in the real estate market, if you're in this game long enough, you realize that it makes sense to actually own the real estate instead of helping people do it. And we love helping people do it, but we started after our business. Kind of was solidified, and we were able to create systems and processes and hire people. Now we're transitioning into purchasing these assets ourselves.
Yeah, I love that because people come to us because they're real estate investors and they want to deal with other real estate investors, right? We're not going to say to a real estate investor, "Oh, give that up and put all your money in an RSP," because we're real estate investors ourselves. So I want to deal with a mortgage broker that is also a real estate investor because it's just different, right? It's not like applying for a mortgage on a single family home. So let's dig into the options out there for the average investor owns a couple properties, two, three, four, five properties. What's sort of the starting point for someone going to look at a new building, a new multi-unit building? What's the starting point as far as mortgages? Where would sort of be step one that they would look for a mortgage, or the more traditional approach? What would be the most common approach?
Yeah, so if you're looking at, getting into a 5+ unit, we automatically jump into commercial mode. I mean, there's maybe one or two, banks that would consider a 5 or 6 unit on the res side, but let's just focus on the commercial side because that's where the majority of these guys are going to be. The biggest thing that you have to be able to kind of keep in mind is how you're structuring the entire deal. Every single aspect is going to determine the type of financing you can get. So, first thing we're going to take a look at is the building itself. Is it cash flowing? Is there enough support there coming from the income? If there is, great, we can put you into some sort of, or start to consider some sort of like bank type financial institution on the A side, maybe a B side. We're going to take a look at, the money standpoint, which is one of the bigger issues right now is where are you getting your down payment from? A lot of the new investors right now, some of the rhetoric in the real estate investing world is, okay, go out there, you lock up a building, get under contract, and then find a way to come up with the money to be able to then close on the building, and which is fun. It's a good way to be able to get in, keep as little money out of your pocket as possible. But I think what most investors kind of don't realize is, you can go and lock up this great building, but if you're borrowing money from 20 different people and none of those people are on the corporate structure or the purchasing structure, you're really pigeonholing yourself into some sort of, private type financing. So it really does limit the type of money that you're going to be able to get from a lender, which is also going to eat into your bottom line a little bit as well too. So just being aware of where you're gathering your resources from, how that's going to impact your deal moving forward. And then the last thing I'd say, keeping it kind of general, is just the borrower themselves. We talk a lot about commercial being great because it removes the personal debt servicing, which is true for, the most part when we're comparing it directly to residential real estate. But a commercial lender still does take a look at you from a holistic standpoint. So if you have your own money and the deal works in terms of your debt servicing on the building itself, but if you have a 500 credit score and you have no income coming in and you have a pile of debt, the lender is still not going to want to move forward with you because you're not in a position to be able to afford the building financially. The boiler system goes within the first or second month. You can't wait 6 months for rent to come in and then replace the boiler. You got to have liquid assets. You got to be in a position to be a landlord, right? So even if you pass kind of areas 1 and 2, you yourself still has to pass in the eyes of a bank and the credit department.
So what number of units are you looking to go from? What would be the minimum number of units to look at commercial?
5 units.
5 units.
So yeah, so residential real estate is classified as a single family home all the way up to 4 units, and commercial real estate is 5 units and up. As Ehren said, there are a handful of banks, very small amount, that will allow you to purchase a 5 and 6 unit building with your personal debt servicing ratios. The majority of banks will qualify commercial real estate through a debt servicing approach that Ehren just explained.
Okay, so assuming I'm not doing a BRRRR, or I'm not doing a flip, I'm just doing a buy and hold. What would be the sort of the most common first the mortgage someone would secure for that? What type of mortgage would that be for a 6 unit building? Guy with good credit, good income, lots of cash in the bank, going to buy a building. Where are you going to look first?
Sure. I mean, if the numbers work and you're buying like a turnkey brand new building, you go in directly to CMHC on the purchase. CMHC has the best type of financing. You'll be able to get the most aggressive rates, the most aggressive amortization. You'll be able to maximize the cash flow on the building. It is the best of the best financing. Now, true wealth isn't created through purchasing turnkey multifamily assets. You might be able to maximize the cash flow on a property, but you're not going to be able to really force appreciate the property. And from what we're seeing is most people are purchasing underperforming assets, bringing them up to performing, pulling the capital, keeping the velocity of money going, and then buying another asset. But if you're looking just to buy a turnkey one, CMHC is the way to go. If you don't have the experience in purchasing these properties or managing them, you can have a professional property management team make up for that experience. So, there are a few people who are looking to take on these properties, and with the new, MLI product, there are ways to put very little amounts down, 5 to 10% down on these properties to allow you to get in without necessarily needing to put in those huge down payments we've seen from historical conventional lenders.
Yeah, the biggest downfall to buying that turnkey property is you don't have that same ability to get your money back, right? So when we're taking a look at multifamily and you're getting into, bigger purchase prices, you're putting I guess if you can get into the CMHC route, putting 5 or 10% down is great. But, for some reason you didn't want to go that route and you're looking at a 25% down payment, when you get into these larger multi-million-dollar buildings, it's a pretty decent chunk of money that you're not able to get back out if you're not doing any sort of like value add into the apartment building, turning it over, doing the renovation, stuff like that. So, aside from the turnkey, I'd say the most common type of like steps of getting into your commercial, I think most of the people are taking some sort of private or like B lender repositioning loan. The majority of the buildings these days, the rents haven't been increased in like 10 or 15 years. There's some renovations that need to be done to the buildings. They don't qualify right out of the gate. So you got to buy the building. Usually, private lenders don't have a debt servicing requirement. Our B guys, they have a much lower debt servicing requirement with an interest only payment that helps them, get into these loans with these lower income buildings. They turn over the tenants, increase the NOI, do the value add to the building, and then, we are able to increase your value based off your cap rate and your NOI. And then when we do the refinance into CMHC, if that's the way you want to go, yeah, then we're looking at, up to a 95% loan to value on the MLI Select. You get your money back out, you put that back in, and you just kind of churn that over.
Rinse and repeat. Okay, so A versus B lender. So A being the big banks, B versus the other banks. So what would be a typical B lender, and what are the key differences what a B lender is going to give you versus an A lender?
That's a great question. So A lending being conventional financing, it really depends on the value of the asset that you're purchasing. So if you have like a loan under 1.5 million in like a rural or secondary tertiary market, you're probably going with a credit union. The credit unions are almost as competitive as the regular big five banks. They have a standard debt servicing. It's usually 1.2 DSCR. If people don't know what that is, it's debt service coverage ratio. That ratio essentially is the ratio a bank will look at to qualify your loan. It shows how much mortgage payment the property can support based off of the net income of the building. For every dollar you're spending, you're making 20 cents. And the bank sees that as a self-sustainable asset, which then will give you a loan based off of that ratio. A B lender, which most people are using to actually acquire underperforming assets, has a handful of things that are going to help you when looking to qualify. So one being longer amortization and interest-only options. So as many of you know, interest-only payments are smaller than amortized debt. And if you have a longer amortization, it will reduce your payments as well, which will then decrease your debt servicing coverage ratio. They also have reduced ratios. So instead of 1.2, they'll have a 1 or sub 1 debt servicing ratio. If you're acquiring, they also offer up to 75% of your renovation budget. So you don't have to come up with all the capital to actually do the renovations if you're purchasing these types of assets, because the capital expenditure required to do these projects, they're not small. You're probably looking at 40 to 50,000 a unit. You got 5 units minimum. Most are like 8 to 10. Looking at $500,000 just to outlay to do the renovations. So they also offer that, and they also offer like bridges directly into CMHC. So a defined exit strategy in the back end. So most people are using alternative lenders just because the appetite for people purchasing turnkey multifamily assets right now, unless you're a REIT or you just have more money than God to throw at, to bury your money into exposure in a market, like most people are using those B lenders to get in.
Yeah, and I think people get caught up on the interest rate sometime, and it's like, I did a private loan a year ago, and the guy paid me 15% on the money, and my daughter's like, why would he pay? Like, he was borrowing $1 million. I took 100,000 of it. He's like, why would he pay 15%? Like, that's crazy. And I'm like, well, let's show the math on what he's going to make. He's going to make 2.1 million on the deal. Do you think he gives a crap about paying 150 grand of interest on $1 million for a year? But what kind of interest rates are you? So I don't think the interest rate is the key, but it is relevant. What kind of interest rate do we see on the B side lending versus the A side lending today?
Yeah, A side lending, if you take a look at CMHC, depending on the size of the loan and where it's located, I'd say you're probably between like 4.25 to like 4.5 on average. So that's your insured top tier type rates. And that comes with amortizations up to 40 and 50 years. So that's definitely going to give you your cheapest cost of borrowing. Your uninsured aid stuff, again, depending on location, your mid to high sixes. A 25-year AM. If you have a new enough building, you can maybe get that up to a 30-year AM. But on average, you're around 25-year amortization. When we take a look at like our B banks on these repositioning loans, the bank that we work with, we get a bit of a discount, but you're anywhere between like 8.5 to 9% with these guys. But the fees that you're going to be paying is a bit cheaper than what you would be paying with a private lender. And that 8.5 to 9, that's an interest only mortgage. I mean, you're getting interest only from a B bank with a bit cheaper fees. And then when we go to our private type lenders, you can be anywhere, from 9 to 11% right now in first position in a good market. Fees on average, you're anywhere from like 3 to 4% of your total loan. And those are, for the most part, interest only. There's the odd lender that will do like a 50-year AM on the private side if you can get in with one of these mortgage investment companies. But it is a bit higher cost of borrowing on the true private side. But some of the other benefits of going with the B lender is that you get those repositioning specific type products. So you get the additional loan to cost to help cover your cash for keys, to help cover your renovations, and you get that direct access into CMHC afterwards as well too. Where with some of the private lenders, depending on who you go with, you can't always exit directly into CMHC. You don't necessarily get these specific niche products where they're also going to give you some money to be able to help with the renovation. So going back to what I was saying earlier in terms of just locking up a building and gathering money, if you want to get these creative products that are going to help you get across the line quicker and help get you into CMHC that much faster, being able to source the money appropriately and structuring everything from the eyes of a lender, that's going to help you be a lot more successful just in terms of having access to better products.
Okay, so let's say I'm going to buy a $3 million building. It's 6 units plus, doesn't matter how many units, and I need to put in say $500,000 to fix this place up. So if I go to a B lender, they're going to loan me money for the purchase price and for the renovation all in the same one. And how long on average would the person be with that B lender before they moved it into more or into like a CMHC? Is it in some people indefinitely if they have a bunch of units, or what's the typical approach if in that situation, $3 million building, I need $500,000 to renovate it, I'll jack up the rents, it'll be worth more down the road. What would be the typical approach an investor would take on a B lender?
Sure. So we would assess the current net operating income on the property to see what it would service at. But let's hypothetically say we can get the ratios at a 1 debt service coverage ratio, and the lender decides that you can get 75% loan to value. So 75% loan to value, you're 250,000 down on every million, so you're 750,000 down on your purchase. That would have to come from you as a down payment. And then the $500,000 would be outlined in a renovation budget. It's retroactive, the same way you would have it with a construction loan. You do a certain percentage of the project, they then pay it back. You do a certain percentage of the project, they then pay it back. So you still would need capital up front to be able to front load the renovations on the property, just not the entire amount. You'd be able to put it up and then they would pay it back to you. In regards to how long it takes, some guys are really proficient with it and some deals allow you to have a ton of vacancy. You could do these projects in less than a year. We can be flexible and have terms that are open after 6 months, 3 months, 12 months. We can have 18-month terms, 24-month terms, depending on how large the project is. A lot of it comes down to we can create and curate a product or like a financing solution that works best for your specific project. There isn't like a cookie cutter way to be able to do this. Because if you are focusing on just regular CMHC, you need 12 months of stabilized rents to be able to move into it based off the new loan value that you'd have when you turn over the property. Whereas if you're going into MLI and a certain percentage of your building is underperforming and you're getting your points that way, we can transition you directly to it once you hit the certain requirements. So there are people who can do this very quickly and turn over lots of units and move into CMHC right away. And there's sometimes it's going to take you 12 to 18 months to do.
Yeah, okay. You can roll off up to 24-month terms. So I mean, if you need a full 2 years, you can get to 2-year terms.
And is it pretty common for those to be approved on interest only for that 2-year period?
Yep. So it's important to note that these rates are actually based off prime. So and they tier based off loan amounts. If you have we have preferred financing with this bank. So if you have a loan above $2 million, they're giving us prime plus 1.75 on the rate. If it's under $2 million loan amount, it's prime plus 2. And we can be even sharper for the bigger loans as well. Anything from 3 million loan amount and up, we can start getting really aggressive on those rates. So as we start to see the economy move in the right direction, and possibly, let's say 2024, hopefully, the overnight lending rate starts to drop a little bit. That cost of borrowing is going to go down. 12 months ago, there were guys borrowing 3.5% money, over 5% money, and doing this, and numbers were working, and everybody was just able to do this. Now, obviously, your numbers need to work, and the carrying cost of being able to do this is just a line item, but there's still a huge opportunity, and the majority of our clients are still moving. Despite what you might hear in the media, there's a lot of activity going on, and investors are predominantly moving into this space because of the qualification, because of the definitiveness of understanding the as complete value of the asset, and the scalability of actually being able to do this without necessarily needing to increase your income or pay off a car, or the nuances of just regular residential financing.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
That's awesome. So that's the side A and the side B. And then there's some more creative products for people looking to raise money that the B lender may not be an option for all they need. So what would be the next sort of step for an investor that you're dealing with that maybe the side B doesn't work out for whatever reason? What other options are out there for them?
Yeah, if you can't get your debt servicing to work at 1%, you either have to come up with a much larger down payment. I'd say the average down payment we see is somewhere between around 35 to 45% down on the building. That's if you're looking to go with a conventional lender. We have our private guys that if you're just looking at a hard money lender, in a decent city center, London, KWC, Toronto, you're 75% loan to value. No questions asked, maybe around 10 to 11% interest. You're going to pay your 3 to 4% fee on your loan amount, depending on the size of the building. Obviously, if it's a $10 million building, it's going to be a little bit less, but on average, around 3 to 4% loan amount on the private side. And it's in and out. They don't care where the money's coming from. And they'd like to know that you have a strategy. Obviously, how you're going to get out of it. Just be able to, explain that to them. But, these hard money guys, they're really just, they're equity-based lenders, right? So they're concerned about what is their equity in the property, and does that make sense given the area and the overall plan. And if they're comfortable with it, they'll lend on it. So that's your easiest money to be able to get in. Obviously, on the back end, we have to be able to figure out, is it a viable exit solution? So if your only way to exit out of this building that you're buying is to go directly into CMHC, it does leave a little bit of a gray area, because not every private lender will be accepted by CMHC. So there is some possibilities for some issues there. That's where we start to use our mortgage investment companies, which are really just private. It's just private bank money, right? It's these financial institutions that are borrowing money from big bank lines of credits, and they're just putting it out at a higher interest rate. They're more flexible for sure than a bank. They're still private type guys. So they're not, as focused on the debt servicing, but they do have a lot more questions and, underwriting policies that you have to follow, because they have board of directors, they have shareholders. They got to get, the bank, they got to appease the bank. They want to keep borrowing money from the bank. So your AML has to be in line. And one other thing that you got to just keep in mind too, is that when you move into these mortgage investment companies, on top of all the fees and the down payment and stuff, one thing that they're also probably going to throw at you is your, interest reserve. So depending on what your liquidity looks like and what your experience is turning over these buildings, they may want you to pay 12 months of interest up front, or maybe 18 months, or maybe it's the full 24 months of interest up front, which takes your down payment at 25%, and then maybe add another $500,700,000 on top of that. It gets complicated. So that's why we always preach understanding how you're structuring the deal and how you look to the eyes of a lender, and how it's really going to dictate your financing. Because if you're going into a deal and you got money that's all raised by investors and it's being gifted to you, and you have no money in your bank account, and you're not liquid, the lender's going to be like, well, we don't have any security that you're going to be turning over this building, which means you're not going to have as much rent coming in. You don't have a huge, how are you going to pay our mortgage payment? So they're going to collect a lot of that interest up front versus, if you turned over 200 apartment building, units and you got, 10% capital reserve or 20% capital reserve in the bank and you got a high income, portfolio that's also generating, you're liquid, a lender is going to be more or less enticed to charge this interest reserve. Maybe they're only 6 months instead of 12, or, maybe they're 0 months instead of anything. So having the liquidity and having the experience, it really does go a long way with these lenders in terms of mitigating your costs.
And do you guys at Findlay Mortgage Team, do you guys get involved in private lending where you coordinate the deals between the lender and the borrower?
Yeah, so the predominant amount of our business, and when we advise on strategy and purchasing these assets, we advise using all different types of capital, whether it's MIC money, true private equity capital, A money, B money, commercial, all the way down. So we use all different types of capital and broker all for all of our clients.
Okay, so if somebody wanted to loan money because they like real estate, they like the returns, but they don't want to be involved with tenants, termites, and toilets, they could reach out to you. And the same if someone was looking to borrow private money and they had a good deal. Don't come to you guys with crap. But assuming it, the deal made sense, you guys can talk to people and walk them through that. Excellent, cool. You talked about the mortgage investment company. Can you just expand on those a little more? Like when would you use a mortgage investment company, and so a little less stuff than like an A or B lender, but more than a private loan? Would that be sort of the information they're looking for, the ratios and stuff?
Yeah. So like I said, like a mortgage investment company, I'd say at least 98% of them follow similar AML, so anti-money laundering rules that a bank would, because they're getting their money from the bank. So they want to verify, at least have a really good idea of where the money is coming from. Is it 20 different guys that just gave you prom notes, or, is it gifted from a parent, or is it, a partner that you've been working with for the last 10 years and you guys just have a JV agreement? Like having a good understanding of where the money's coming from is what a MIC wants to see. Now, every situation is going to be kind of different, but, the more that you can explain, the more that you can show, and the closer you are to actually hitting those AML rules, it's going to give you your better financing. So a mortgage investment company, you might be able to get a bit more competitive on the loan to value. So, there's a MIC out there right now on the commercial stuff. They're considering up to 85% loan to value if the deal fits. So, obviously they're looking for, home run type deals, probably in a big city center. They want you to have liquidity, cash flow, strong exit. But, if you can fit all these boxes, you're going to be able to get your top tier financing. They build their fee into the mortgage amount. So, when you're looking at a 2% lender fee on a, high $1 million deal, it adds up pretty quickly. If you can build that into the mortgage, it's just less cost coming out, of your pocket. So, you get a slightly lower interest rate too. You're closer to say like a 8.5, 9.5 versus some of these like 10 to 11 on the hard money guys. Some of the MICs, I'd say a good amount of these MICs have certificate of insurance capabilities with CMHCs, which means that you can easily exit right into CMHC. The private lender is able to, be the bank that sends it in versus having to transition out and bridge into a different lender and then take, an additional 6 to 8 months to be able to get that done. So you get slightly cheaper money. You're going to get slightly better terms. Some of these MICs offer that loan to cost renovation type financing as well too. So again, you're going to get a little bit, a bit more leverage that way, some help towards the rest of your renovation. So it is better structuring than what you would get just going right into a hard money lender. But again, you got to be able to follow, some of their underwriting parameters. Like I said, if you're just borrowing money from 20 different guys, you're going to have a hard time getting in with these MICs.
Yeah, the great thing about these types of financial institutions too is that they're niche. They're the absolute best at the type of deal that you're looking to do. So we'll have there's hundreds of mortgage investment corporations out there in the country, and each one of them are really good at something. So if you were doing land development, there'd be a few of these guys who focus on that. They'd understand everything there is to know about it. They'd be able to give you really great terms on it. Whereas, if you go to like a private lender, they've got capital, and they just know what like leverage is, and they just know what equity is. So they might not know that in this spot, in this area, this is going to make sense, whereas this doesn't. So you're dealing with people who are experts at what they do in the field that they're lending in, and they're very geographically focused. So it allows us to offer the best terms and financing solutions when we're dealing with guys who know your area and know the type of product that you're dealing with.
Yeah, a lot of the guys that run these mix, they have a background, right? Like one of the guys that we work with on a pretty consistent basis, he started at CMLS. He was a multifamily loan originator there as an underwriter. He underwrote like $1 billion in loans himself. He had 20 something years of industry experience seeing market growth, and then he left to go do his own thing. So he understands real estate. He's seen it for 20 years. He knows how to underwrite. He knows what risks and leverage look like with different banks. So like these guys know what they're doing. And like Josh said, they have that niche. So if you have a very specific type of deal that you're looking to get done, and you're like, if someone only understood this deal, they'd want to lend on. Well, that's where these guys come in, right? If you can take it to someone who understands that type of real estate, it's going to give you a much better opportunity to be able to get that deal done than just take it to an equity-based guy who's like, well, it's land. I only want to be at 45%. Sorry.
Yeah. You guys mentioned location a couple times. Can we just dig into that a bit? Because I know I do private lending, and I get a lot of things through my desk. Hey, would you want a little money on this? And it seems I get a lot of homes in rural areas where they're second homes. Like, guy from Ontario buying a place on the ocean in Nova Scotia, thinking, oh, great, it's going to be in the ocean. And I'm looking like, it's a town of 200, a village of 200 people. Like, great. If I loan them money and I got to foreclose on the house, hopefully one of those 200 people want to buy it, because if not, how long is that going to be for sale? So I think that's why it comes to private lending. What about on the multi-unit side? Is it the same idea? Like they're going to be hesitant in a small rural community versus a major city center where they're more comfortable in the options for them?
For sure. Your choice of geographical location for your investment is going to have a huge impact on the cost of your financing and how you're going to be completing your project. From a private lending perspective, everything comes down to marketability of an asset. For yourself, if you had to repossess that asset, you would then have to put it on the market and try to get a fair market value for it. If there are 200 people and out of that 200 person town, 3 people want to actually move there, it's going to take you a long time to sell it. And from a lending perspective, all these lenders look at your asset, unfortunately, as lunch. Like, if I have to assume this and I got to take this over, how liquid is it? How fast can I sell it? Is there a market for people who are looking to buy it? And that's why a lot of the conventional financing solutions are limited when it comes to these tertiary markets. You'll hear a lot of people going, I'm going to get something in Sudbury. Well, there are only a handful of banks that really like Sudbury. So like if you're pigeonholed into not using those banks anymore, it becomes really difficult to do it. So just understand that when you are looking to make these investments, it's not just let me find the cheapest, cost per unit approach and figure out how many units I can get. Because at the end of the day, if you can't get the best financing, or you're buying a $3 million building and now you get pigeonholed into private expensive commercial debt, your bottom line is up, and then the cost of that single unit that costs you $70,000 isn't necessarily as viable as it once was when you were looking at the deal to begin with. So just understand that location is a very, very important thing. Like the B lender that we were speaking about, they only lend in urban areas. Like they'll lend, they're obviously Kitchener, Waterloo, Cambridge, anywhere GTA area, even in like Ottawa. But if you're outside that, it's an exception to be able to get these rural deals done. We understand that numbers are working best there, but that you're probably looking at a credit union at that point, and then you have to meet the minimum debt servicing ratios. So when we sit down with our clients, we sit down and have them understand the product first, the requirements of those products, and then you can choose your location after we understand the products. Because if you understand how you're going to exit and how many times you're going to have to refinance, every time you touch the financing in that property, it's going to cost you money. And we obviously make a living on it, but we also want you to ensure that you understand that when you're turning over capital on a $2 million loan, that gets very expensive very quickly. So location is probably the most underrated aspect of a deal that people overlook.
Yeah, we're talking like Windsor, Sarnia for some of these guys is like a no, like we don't want to lend in that area because it's not like, yeah. So like they definitely get picky. You just got to understand, you got to put your lender hat on, right? Like you got to understand how a lender is looking at this. You're looking at this as like, this is a sick deal. There's already vacancy here. Like, 60% of the units are all vacant, and it's a low purchase price because it's in a rural area. It's been on the market for 180 days or whatever it is. But from a lender standpoint, they're like, yeah, that's exactly the issue that, if we have to take over this building, right? And that's where that whole borrower covenant thing comes into play. It's basically, how much are you yourself offsetting the risk that this bank is taking on? If they take on this, 20 unit building that's in, the absolute middle of nowhere, like you said, a 200 population town, what happens when you go bankrupt in the middle of the project, right? They have a property that needs to continue to be renovated. It takes up, they pay their management fees. How long is a bank going to have to sit with this property on the market before they make their money back? So, that's why they're only 70% in this area and not 75%. They're taking a look at every single risk that's going to be outlined, and how much of an issue is it going to be for them when they have to go and sell it. And it comes down to things like vacancy as well too. When we're underwriting the numbers and we're trying to get away with a vacancy, vacancy in an area might be 1%, but a lender, may not allow you to underwrite your deal with a 1%. Maybe they're 3 or they're 5%. Same with management. Well, you might be, living in the building and operating the building yourself, and they still may want you to qualify with a 5% management fee, because if they have to take this building over, well, one of their underwriters isn't going to live in the building and manage it. They're going to have to hire someone to go in and do it. So, when a bank underwrites a deal, they're looking at it from what happens when we have to take this deal over and take it to market and try to get rid of it. And that's how they're looking at it. So it's, it's trying to mix, like put together Swiss cheese, right? How much of this can you get to line up?
Yeah, and I find like experienced investors know before they buy what they can get for a loan and what are the options and what, ballpark, what they're going to be able to qualify for and the percentages. And rookie investors go, oh, what a great deal. It's only $60,000 a unit or 100, whatever it is, in middle of nowhere. And then it's like, now how do I get financing for it? And that's a big difference.
It's a scary place to be.
Okay, so a lot of real estate investors are also business owners. So control and compound. So we want to go buy a building for our staff to house, maybe have some additional units we can rent. What's out there for someone that's going to be operating a business in this building, or operating a business in this building, owner occupied, but still have additional income from other rents? What kind of financing can they qualify, and is that different than the other traditional financing?
It's much different. There's there's a handful of very niche, unique products for your owner occupied commercial stuff. So, if you're a realtor and you want to get your own office and you want to buy it, or if you're anything that you're going to be occupying that space in there, certain lenders will start to take a look at your actual corporate financials and figuring out, net income after tax. You have your certain add backs that they're going to give you, any bad debt, amortization, stuff like that. They're going to add all that back in. But, if you're able to show that your corporate financials can cover the annual mortgage payment, there are certain lenders out there that will just give you, your full value type of loan, because you've proven while the business itself has enough income to come in and carry the mortgage, that's good enough for some of these lenders. If there's multiple other units that can be rented out, obviously you can use that rent to help offset the cost as well too. But these handful of specific lenders have a very unique product, and the leverage can be quite high. Like if you take a look at like BDC, like some of their specific products that they have, if you can get the numbers to work, they'll give you 100% loan to value on your purchase. If you're like a healthcare professional, doctor, vet, there's government programs out there that with the right lender, again, you can get 90, 100% loan to value. They'll offer you operating lines of credits and stuff as well to be able to go with the business also. There's a lender out there where if you're buying this, it's like, say it's a 2-unit building, you have a nail salon or a hairdresser or whatever in the bottom and you live up top. There's specific lenders that again will give you up to certain high loan to values on that type of building as well too. With that specific structure, it has to be a piece of residential and a commercial on the bottom. So depending on the situation, there are some very unique and niche products that, if the numbers work, you can get 100% loan to value. Other than those specific type lenders, when you get into commercial, industrial, stuff like that, you do start a much lower loan to value. You can be anywhere from like 60 to 65% starting. And then, depending on the rest of the boxes and the strength, you can slowly start to kind of creep that up. Like an office building that has, grade A government anchor tenants versus an office building that has, just mom and pop type stuff. You're going to get two completely different loan to values and risk factors when the eyes of from a lender. But if you own or occupy and you got a strong business, There's really creative financing out there for you with banks too, not just private guys.
And the same for renovations. If you want to go and buy a property, owner occupied, renovate it, good financing options for the financing as well as the principal payments.
I'm sure they'd be happy to wrap in something in there to help you get that building fit to run. Yeah.
Cool. Okay, so we talked about all kinds of different mortgage options. What did I miss? What else? What other unique products do you guys see out there that you can offer people that they don't typically see on an everyday basis? Any other products you see out there that investors are using?
Let's talk about business for stuff on the rest side.
Yeah, so there's business for stuff on the res side. There's also like, you can be creative as a buyer as well, guys. Like, we're starting to see this market is pushing people to sell properties. And in a market like this, you're going to see people more apt to offering vendor take back mortgages or being more creative that way. These projects might seem almost daunting, like they're impossible to take on, but a lot of these owners are legacy owners. They're guys who own these things for so long that they have giant equity positions and they're starting to plan their retirement. So they can't sell all these properties at once because they're gonna have a giant tax burden to be able to deal with it. So they're more apt to being able to give you 70-75% VTB and let's say 4% interest rate, which is way better than what the bank's gonna give you. There are so many creative deals happening right now in the market because these guys are wanting to offload. You might pay a premium up front, but the VTB is going to allow you to have better financing terms in the back end to allow you to get in. So, one of the things we're seeing lots of is just being really creative with the seller of a property. Now, obviously, we can't get you a mortgage on a VTB because the VTB is going to be your mortgage, but we're starting to help plan out the track or like the plan for people who are purchasing these properties. How many units you got to turn over? How do you get into better financing after that? So this market is going to bring a lot of opportunity, and one of them is going to be vendor takebacks from sellers on these buildings.
Yeah, I think vendor take back. You'd asked me 5 or 10 years ago. Why would the guy selling the property? He just wants to sell it, but he wants to sell it for top dollar, and he has to do something with the money you give him back. Like there's a 70-year-old wants to be a retired guy. What's he going to do with $1 million? Go earn 2% in a bank account or 1%? Like, he needs to put it somewhere. And if he can get the purchase price he's looking for, and then really it's an investment now for him, this vendor take back. He's got an investment that's paying him. And let's say you screw up and you don't run it. Well, I'm pretty sure he has experience running that building because he probably did it for the last 30 years. Yep. So, foreclosing on that is, still not plan A, but it's still going to be a lot simpler for that guy than someone that's not familiar with the building and stuff. Cool. Okay. Now, how do listeners get in touch with you? I know you guys, your YouTube presence is fantastic. I love your videos. I encourage everyone to check them out. Where else can we find you?
Instagram, at the Findlay Mortgage Team, I believe it is. The Findlay team?
Yep.
The mortgage team. We're on there. We each have our own social media. Mine's just my last name, Laycock 22. J.
Yeah, mine's at JFins. You guys can follow us. We'll give you all of our contact info if you guys are seeing this. Click on the links below. We are decently active, on social media. You guys can send us a DM. If not, our contact information is on our website as well and on Google. Just Google the Findlay Mortgage Team. Our phone number pops up. You guys can get in contact with us. We work 27 hours a day, every day of the week.
That's awesome because I really encourage people, if you're a real estate investor, you should be dealing with investor-focused mortgage people, and Findlay teams absolutely check that box. And you should also be dealing with people that are actually investing in properties. And I love that you guys are doing that. That's awesome. Great information. Very educational. Appreciate it, guys. Check out the Findlay Mortgage Team. Thanks for watching. Thanks for listening. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.